Take a look at this, guys. Nate Daddy 33 tweets, "Isn't it amazing how millions of investors across the world decided to buy and sell these exact 4 stocks all at the same time? Down to the effing minute? No way this could be a computer algo or manipulation. Gary Gensler surely wouldn't allow that." Ah, the joys of algorithmic trading. Aside from this nice little George W. of crime that we are seeing on the chart, we are once again seeing several stocks that are a part of the so-called meme stock basket trade in tandem with one another, underscoring that there are so many stocks that the hedge funds can't allow to run that they've opted to use the exact same trading strategy in order to suppress them. And before anyone shouts out, "But what if investors just love all of these stocks?" Remember that all the volume on these stocks has been increasingly low, and more than 50% of all shares traded on a daily basis are shorted into the market. This once again shows what we've known all along. The hedge funds are increasingly overleveraged, and they continue to live in a compromised position given that they took out a staggering number of short positions in companies that they believe to be failing. However, the strategy that they are currently utilizing is twofold. One, they themselves need to stay afloat and avoid margin calls at all costs. But on the flip side, they are desperate for us to sell. Matt C. tweets, "They are taking our memes to lows while they crash the market. They want you to think, OMG, things are bad, I'd be better off with the cash with this downturn." Guess what? I'm not freaking leaving. With the exception of Tuesday, the overall market has been awash in a sea of red as the S&P tries to find its bottom and the catalysts on the international scale continue to heat up. While the Federal Reserve will likely raise interest rates again, driving the broader economy into a recession, even the United States has stepped in to try and stop what's coming, albeit to no avail, fearful of what a global recession might mean for the next several years. The primary issue here is that Wall Street continues to engage in risky behaviors that could very well crash the economy. They are so overleveraged that they have no other choice than to spend whatever capital needed to convince the apes to sell, given that the ultimate cost would very likely bankrupt their firms. This is further underscored by several other things that we continue to see on Wall Street, whether it is the mass exodus of executives, the layoffs that are already permeating the street, or the fact that several firms are working to hold on to capital like there's no tomorrow. Unusual Whales tweets, "Just in, asset managers including Blackrock and Schroders plc are limiting institutional investors' withdrawals from some UK property funds after a wave of requests to move money, per Bloomberg." One of the major stories over the past week had to do with the British economy and the possibility that their weakening currency, soaring inflation, and overall economic weakness could collapse their economy. The pound and the dollar are nearly at parity, a level that hasn't been seen in a generation, and there were reports that the entire British pension system could have been wiped out in the middle of last week. This has led investors to be skittish as they work to move capital around to mitigate losses and ensure that they live on to fight another day. However, just as we saw in firms like Citadel last year, companies like Blackrock limiting investor withdrawals, however this time, it's on the institutional side. This further underscores the overall sentiment on Wall Street. In a time like this, cash is king, and certain assets are just too risky to wager on right now. And guys, to be clear, this is just the hedge funds, but what we are starting to see in the global banking system is, to say the least, concerning. Charles Gasparino tweets, "Breaking, U.S. investment bankers tell Fox Business Swiss National Bank has weighed merging Credit Suisse with another bank such as UBS. Unclear if there's official talks or this is just some rumblings, but growing consensus there isn't a need for both institutions competing over same turf." Over the past few months, there has been inklings that big banks were in trouble despite the overwhelming cries from the top that everything was fine. This includes banks like Credit Suisse, who took a massive loss after the collapse of Archegos last year, and whose CEO issued a memo earlier this week that closely mirrors the rumblings that we heard in 2008. Credit default swaps are through the roof, the overnight reverse repo numbers are higher than ever, and overall, while the cries from the foreseeable past indicate that the financial system is strong, all evidence is pointing to the contrary. This once again underscores what we have been saying for months. There is such a degree of interconnectedness on Wall Street that at times, it's hard to see where the banks end and the hedge funds begin. And while this is likely going to be incredibly painful for the broader economy, this is bullish for AMC. We continue to see these funds and banks engage in bad bets, both stuck in ones that they took out during the pandemic, but also actively opening new positions in stocks like GameStop and AMC. And as long as the apes continue to hold the line, they will emerge victorious. So while on a day-to-day basis it is tough to watch the way in which the chart is manipulated, they cannot change the inevitable. And with our timeline coming to fruition, I have never been more bullish on AMC. Well, that's it for this video. As always, please make sure to go down to the bottom of the page, tap that thumbs up button for me, and subscribe to the channel.